Okay, I think we'll get started. So, yeah, good morning and thanks for joining us on the webinar this morning. What you need to consider financially when choosing whether to stay down under or return to the UK. So, I'm in the UK office. I'm a financial advisor over here, and I'm joined today by John Harrower, who is in our Perth office, and he will take you through most of this webinar. I will then rejoin you at the end of the webinar, unless John wants me to jump in at any point along the way for the Q&A. So if you have any questions as we go along, if you can pop them in the Q&A section down the bottom of the screen rather than the chat, then we can then go through all your questions at the end and hopefully provide you with an answer. So I'm going to hand over to John. John, are you there?
Yep, all here.
Excellent. Well, take it away, John.
Okay, and just before we start the presentation, all the information we're providing today is general information. It's not personal advice, so please be aware of that. It's quite important to know, the topic that we are dealing with today, which is the consideration of people who have moved from the UK to Australia and now are deciding what is in their best interest to stay in Australia and retire, or potentially moving back to the UK and what those financial consequences could be. A little bit about BDH Sterling though. The beauty of our operation is we are a global company, and we have dual licensed advisors, meaning that we have advisors in Perth, Melbourne and Sydney who are licensed not only to give advice in the UK, but also licensed to give advice in Australia as well. So we get the best of both worlds. We also specialise in defined benefit scheme transfers from the UK to Australia. So if there is a consideration of wanting to move or potentially move your UK pension from the UK to Australia, we have specialists in those areas that look at all the strategies and advice that can be provided to you. And like I said, the advice provided is under one roof in Australia. So for those who are living in Australia, you're dealing in hopefully better time zone hours as opposed to being 8 hours behind in the UK. We're also able to provide financial services or advice on Australian supers. We can provide tax advice both in Australia and the UK through our BDH tax division. And obviously we are specialists in retirement planning, both in the UK and Australia. We've actually been transferring pensions from the UK for the past 15 years. And we've had to deal with a lot of legislation and regulation changes. And obviously we've updated and provided strategies to cope with those changes along the time. The biggest question that any of you will have is when and where you want to retire. And that has emotional decisions and that has financial decisions. So hopefully when you make a decision of whether to return to the UK or stay in Australia, that you do source some sort of financial advice from a financial point of view, because they can have consequences, which we will go through. But along the way, it is an emotional decision as well. You may have family ties back in the UK, and COVID has made that even more so in the last 2 years, where you've struggled to actually get back to see the family or friends. Importantly, though, is designing a plan for when you want to retire, how long your money will need to last in retirement, and all these sort of questions are asked by our financial advisors so that we can outline some sort of retirement plan for you going in the future. Specific to that is obviously cash flow planning, and that's not only in retirement but pre-retirement as well. So we really need to know where you are currently from a financial position now, looking at potential future commitments. If you have children who are going to university, or you're intending to go on a large trip, or if you're intending to take on a home loan or a mortgage for your own residential property, all these things come into line with strategizing the cash flow working towards the goal of retirement. And it helps us determine how we can manage those priorities. In other words, can we pay off a home loan quicker? Is there cash flow available that we can actually pay off that earlier? Or how do we fund the university fees? Or how do we fund that that holiday, and when is it? And a key to all this is trying to get to a situation so that when you come to retirement, there is that income that you believe is comfortable enough for you to live on long term. Part of the way that we do that is, as I said before, is taking all the information from your current position and future expectations prior to retirement, and also determining what sort of income that you think you're going to need in retirement, and putting them into some cash flow analysis. And sometimes that can be, yes, we can definitely achieve that. And sometimes it can be, we're way out of the ballpark and we don't think it's going to be achievable from a long-term perspective. And that's where the strategies come into line, and try to give you a plan designed to get to where you want to go. The next thing I want to look at is potentially looking at pension contributions, not only in Australia, but in the UK as well. And there's different tax regimes for those pensions. So primarily contributing to your pension fund in the UK is a tax-free effective strategy. Whereas Australia, our tax-free strategy is obviously using your superannuation and converting that to a pension at retirement age, and that becomes a tax-free, non-assessable income in Australia. So there's two different strategies we can actually use to top up either the pension and the superannuation, if they're both going to be used. So we consider contributions after super contributions after making UK contributions, but that's only if you're going to retire in Australia. Primarily, if there's an indication to move back to the UK, there would be different strategies that we would consider as well. And the aim is basically to get to a situation either in the UK, if you're retiring in the UK or Australia, that we're aiming to maximise the tax efficiency from your retirement assets, and minimise, as I said, minimise that tax as best we can. We've got to identify your retirement income as well. So we will think, oh, right, well, we're going to use a pension or a super to retire on, but it's not necessarily where all the income comes from. Primarily, there are different sources. One of them is potentially any UK state pension if you've reached the maximum, the minimum working years of contribution at 11 years. Up to, I believe it's about 35 years in the UK to receive the maximum UK state pension. Alternatively, we have age pension, government age pension in Australia, which has an asset and income testing situation, but could be a source of income for retirement in Australia on top of any retirement benefits that you've built up. It could be from any investment property or rental income coming through, or it could be investment portfolios where there's an income source coming from there as well. So looking at all your assets and where it's being built is developed into a plan or strategy focused towards your retirement plan of achieving the income, annual income goal that you wish to achieve. And in addition to that, obviously preparing for some sort of savings outside of that income source for the planned events and retirement of travel, change of vehicles, renovations to the home. And all those different sources of income have different types of tax liabilities, and those tax liabilities can be liabilities in the UK, or it can be liabilities in Australia. So all those particular sources of income, when we're doing a strategy or planning, have to be brought into effect to see which is the best course of action to take. Like I said, we've got 2 countries and 2 different tax regimes. Primarily, the UK will be using different types of investment. They're called investment wrappers, but in Australia, they're called investment platforms or investment choices. Primarily what would be invested in the UK in their setups over there could be totally different to the Australian setups that we have here. And that's an advantage in a way where we can use those different investment options going forward, as opposed to being stuck with one option only, or one jurisdiction to look at. And that helps with maximizing any tax efficiency going forward. So planning and advice on from the 2 countries is quite crucial, as we'll see in the next few slides. Professional advice help define your goals and objectives. The most important thing that we have to do is understand that what you want to achieve. It's not about us, it's about you guys, and we've got to, in our best interests, define your goals and priorities and work towards them with you. And that's where we create that detailed bespoke plan or personalized plan towards your own individual needs and goals. And it should give you advice that gives you confidence that you can plan and work with your advisor each year, and set certain yearly goals, 5-yearly goals, and obviously leading to your retirement goals and beyond. The reason why I said that it's crucial to seek financial advice is if you don't seek that advice and you get it wrong from whatever you do. In other words, you may want to, you might consider transferring a pension over to Australia, or taking a superannuation and withdrawing it and going back to the UK. There is penalties up to 55% of the fund value that apply if it's a non-complying transfer. In other words, if it's not an approved transfer from the UK to Australia, you could be up for a 55% penalty within that fund, and it's quite hefty. So that's where the crucial advice comes from. Confirming if a UK pension is transferable. So not all pensions are transferable, especially for main pensions in Australia, in the UK, such as the NHS, teachers' pension, military pension, firefighters' pension, police pension, and the civil service pension. But when I say the civil service pension, please note that the local government pensions are a transferable pension as well. So it's just those main 6 that at the moment we cannot transfer funds from the UK to Australia to a superannuation. The other thing which is quite relevant is if you were to transfer your UK pension, so you've decided to stay in Australia, but you want to have everything simplified and move everything to Australia. If you are moving your UK pension to Australia, it has to stay in a recognised or overseas pension scheme for 5 relevant years. When I say relevant years, that means if we were transferring it today, the first year to start that relevant year would be the 6th of April of this year. So it's going to be 5 basically tax financial years. And the reason why it has to do that, so if you brought it over here and then withdraw the money or invested it incorrectly, you could be up for what's called an OTC, or overseas tax charge, and that could be up to 25% of the transfer value brought across. The other consideration is if you were going to access your superannuation, or consider access to your super if you're moving back to the UK. And in Australia, it's not as easy as the UK pension transferring to a super fund over in Australia. There is no reverse, so supers can't be transferred to a pension fund in the UK. And in addition to that access to the superannuation, it really only starts at the age of 60, and they have certain conditions of release prior to 65, meaning that you would have to be permanently retired to actually withdraw a lump sum from your superannuation. And at 65, though, it meets full condition of release, so access from a lump sum withdrawal can start from there. But again, it comes with consequences. In Australia, if you were accessing your funds at 65, would virtually be a tax-free withdrawal. If you were doing that and being a UK resident for taxation purposes, could have some tax involved. And again, that's where you need to really source some financial advice on the timing of when you access your superannuation. For those who are a little bit younger, don't have the luxury of withdrawal of their superannuation funds, but are considering moving back to the UK, like I said, the funds would stay in superannuation till at least the age of 60, and they would be in what we call the accumulation phase. So basically what that means is it stays exactly how it is now, where the investments are busily trying to earn money. The income from those investments are taxed at 15% and paid to our lovely Australian government. But it's the ensuring that your investments or your asset allocation within your super is appropriate. So are you maximizing your returns according to your risk? Like I said before, supers are taxed in the UK if your decision is to move back to the UK and class as a UK resident for taxation purposes. And primarily in Australia, most people know that when you commence a pension in Australia and living in Australia, your pension fund is tax-free and not assessable. However, moving back to the UK would be classed as a foreign income. If you're still receiving that pension from Australia, it would be classed as a foreign income and is taxable in the UK. In addition to that, moving back to the UK and becoming a resident over there, all Australian assets are subject to inheritance tax if, as I said, domiciled in the UK. That's your superannuation, and can also be if you have a residential property that you've left behind in Australia that you haven't sold. So these are considerations to talk to an advisor about and the impacts that would have. And it's, the big questions of do I stay in Australia and take my super as a tax-free lump sum? There is a strategy there that avoids tax, then moving back to the UK. So we're trying to optimize your assets from a decision of moving back to the UK permanently or retaining in Australia. And we're trying to optimize when you should be withdrawing funds, selling assets prior to moving back to the UK to avoid any of those, am I going to pay tax in the UK, or am I going to pay tax in Australia? So all those decisions, again, it's sourcing a financial advisor and going through those individual assets, individual goals, objectives, income streams, and making the ultimate retirement plan for you work. I'll hand you back to Paul. I believe we've got a few questions and answers, and I'll get Paul to let me know what those questions are.
Yeah, thanks, John. That's useful information. We've got a few questions come in. Keep them coming in. We'll basically answer them as long as you're putting them in there. So we'll go for the first one, which is it says, what are you seeing in terms of numbers of expats and Brits looking to return, move to Australia? Are numbers increasing, decreasing? What are the main factors driving this? In your experience, what proportion of people end up moving back to the UK having decided to move to Australia? What are the main factors driving this change of mind? Okay, so I don't know the actual figures, but all I would say is over the last couple of years, during this period, we basically haven't seen a drop in numbers. It seems quite consistent with what it was before in terms of people wanting to move between the two countries. The reasons for the change, for the moves, might be slightly different, and with those people that are moving from the UK, they have been having difficulty getting their visas. The visa time scales have slowed down with a lot of them. Plus, also, even if they have got their visas, they've been struggling to get flights, haven't been allowed into Australia, for example, or just haven't wanted to travel in the current conditions. So it has been difficult from those point of view. But in terms of numbers, not really seeing a change, but the reasons, as I said, can change. I'm working with a number of Australians in the UK at the moment that are moving back to Australia, whereas their initial plan was to stay in the UK for another 5-10 years. They're now thinking, no, we want to move back in the short term because they want to be with their family. And I think that COVID really has heightened that sense of wanting to be around the people that you love, and that has changed people's opinions. And people moving back from Australia to the UK, it would be a similar reason for doing that. In terms of what proportion of people end up moving back to the UK having decided to move to Australia, again, I don't know the official figures, but I've been doing this for 12 years now, and of the people that I've worked with, I've only had a handful come back to the UK, and they were for various different reasons. Couple for family. One of them had been over there for a couple of years, really enjoyed it in Australia, but just decided they wanted to come back to the UK. It's obviously different people have different circumstances, and that's what John was saying about the financial planning and making sure that we take into account people's circumstances and adapt to them as they change over time. But yeah, in terms of the people that I've worked with, I've only had a handful come back to the UK. But there again, I like to think that those people that have sought advice are the sort of people that plan properly for these things. They're not going over to Australia on a whim. They're not going over there unprepared. So the very nature of these people, seeking advice, I feel probably means that they're the sort of people that are less likely to return than those people that just go over there completely unprepared and then realise that it's not what they thought it was going to be. So obviously that's a sell for financial advice, but it's also I just think we're probably dealing with a different nature of people than necessarily the wider picture. Sorry I can be more specific with the numbers, but that just gives you a general idea of what I've seen over the last couple of years and over the last 12 years that I've been doing this. Okay, so the second question from Sean says, what do you mean by a non-approved transfer that could incur a penalty of 55%? Aren't all transfers approved? Well, it has tightened up over time, and we've got these QROPS rules, Qualifying Recognised Overseas Pension Scheme. So if you transfer your pension to Australia, it has to go to a super fund over in Australia that has QROPS approval from the UK government. As long as you're transferring to that, then there's no issue there. And in fact, UK providers will ensure that you go to a QROPS. They will do their necessary checks to ensure that there's a certificate, a valid certificate at the time etc. But it's what happens after you've transferred in terms of what you do within a specific period afterwards. For example, you still can't invest in residential property within your pension fund because that's not allowed under the UK rules. You have to adhere essentially to some of the UK rules over time. Now, that's not as restrictive as it used to be because we got a lot more flexibility in pensions in the UK than we used to. So when these rules first came about in 2006, it was a lot more restrictive in what you could do with your super fund afterwards, particularly if you were at retirement age. There was a limit on how much you could take out each year in line with UK rules. But now we've got more flexibility, it's not so much of an issue. But if, for example, during that period you were to transfer your money from the CUROPS into a non-CUROPS scheme, that's when you would also incur a penalty. So there are things that you could end up doing with your pension that could break the rules, and that's where we can provide the guidance and make sure that you fully understand what these rules are before you start making any decisions about them. Okay, the next one. In order to reduce management fees, can I manage my own pension in Australia in the same way that I can in the UK in relation to a SEP? John, do you want to take that one?
Well, the best answer is yes. If you are used to managing your investments within a SIP, then certainly if you have a CUROPS recognised self-managed super fund in Australia, so long as you adhere to the investment rules, as Paul mentioned, certain things like buying a retail property or artwork, etc., like that. As long as you're not in that, if you're doing the main streamline investments of managed funds, shares, etc., like that, then yes, you can manage your own investments. But we always recommend that you have an advisor at least guide you in that area, but it's entirely up to you. Paul, you might be better at answering this one than I would, but part of the acceptance or transferring funds from the UK to Australia is doing a pension transfer analysis report that actually analyzes whether it's worth transferring the pension or not, or in other words, if it's in your best interest. Now, that's a lot of that is based on an investment portfolio or strategy based on a certain percentage return. So I guess if you were to receive the funds over here, you would be responsible for your own reporting back to HMRC. But again, would you be investing in a portfolio that's giving you the return that we've assessed would be in your best interest?
Yeah, and that's one that we need really a lot of information about, and in terms of what John's talking about in terms of the doing the analysis and everything, is if you've got a defined benefit scheme, so final salary or career average revalued earnings, as a lot of them are now in the UK. It's a case of trying to assess whether you should transfer that, and yeah, we need to know details of where that's going to, how it's going to be invested, so that we can make a fair assessment as to whether it's in your best interest to transfer. Because much as there are tax advantages to transferring, a superannuation fund in Australia is more like a personal pension in the UK, in that you are invested, well, like the SIP that you're talking about now. But again, even with the SIP, when you're transferring it over, there's limits on how much you can transfer each year over to Australia, and there's also limits in terms of age as well that you can do it, and the test that you have to pass, a work test, once you get to 67, although that might be going out the window this year. But yeah, it's so there are various things that need to be considered, but certainly in terms of the investments, a good assessment, a good analysis will help you to work out whether that's actually in your best interest to do it that way, or whether actually it might be better to have it professionally managed. Obviously, that decision comes down to you in the end. So, Peter, you've got a question. Can you continue to pay into a SaaS from a UK company you were a director in whilst Australian tax resident? Once you're Australian tax resident, there's certainly limits on how the shorter limits on how much you can pay in as a pension contribution. From a personal point of view, from a UK company point of view, it will depend how it's set up. I think that's one that's very, very specific, and it's probably worth having a conversation with us about. Yeah, I mean, if you want to get in contact with inquiries@bdhsterling.com, just drop us a note there, and then one of us can have a conversation with you to work out exactly what your situation is, and then potentially provide you with some guidance on that one. Tim, if I retire at 65 in Australia, withdraw my super as a lump sum and sell my house and car, what would my tax liability be on arrival in UK, and then later if purchase another property or invest money in the UK? There wouldn't be, basically, as long as you're withdrawing that super while you're still in Australia, and also importantly that it's not within 5 years of you having left the UK, if those funds have been transferred from the UK that you're then drawing. As long as if it's a super that you've built up over there, no problem. If it's a pension that you've transferred from the UK, as long as you've been living overseas for more than 5 years, then there won't be any retrospective tax issues when you come back to the UK. But yeah, the super withdrawal is tax-free. Selling your main residence is tax-free. The car, but there's not tax to pay on selling cars. So you would just have the cash. You would bring it back to the UK. There's no tax penalties on bringing cash back. So no, you'd be fine as far as that's concerned.
The one consideration would be, especially with super and your residential home, is if you are selling it in Australia and you're living in Australia, yes, it's all tax-free. However, if you move to the UK in a UK financial year where predominantly you will be a UK resident for more of that year than an Australian resident for taxation purposes, potentially you could be up for some tax, not only from your superannuation and taking a lump sum, but from the sale of your property as well. So again, there are strategies to, as Paul said, make it all tax-free, but there are also little pockets where if it's done with the wrong timing, you could be potentially up for tax.
Oh yeah, I mean, timing is crucial. It's a lot of people think, well, I can just withdraw my super tax-free, and they do it where they get involved in the move, and they only do it when they come back to the UK, and then they get a nasty surprise because they're then UK tax resident and end up paying some tax on it. So it is very important to get the timing of these things right. But the thing is, if you're planning enough in advance, there's no reason why any of these things should be an issue. That's what is part of financial planning, is obviously about trying to maximize investment returns and things like that, but a large part of it is also using tax efficiencies and making sure that you don't pay anything that you don't need to pay. Yeah, sometimes you have to pay tax, there's no getting around that, but no need to pay more than you have to, and certainly if you're planning in advance, and you won't get any nasty surprises because you'll be clued up to what you're doing. Okay, so Isabel, if you're not sure where you're going to end up staying, will financial advice be able to help with best assets to invest in when looking at an individual situation? Currently split between the two, but want to be set up for retirement and build wealth too. Yeah, I've literally just started working with clients who are in the UK at the moment. They're Australians, they're in the UK, and they don't know whether they're going to end up in Australia in the future or in the UK. So what we are looking at is the cash flow modelling that John talked about earlier, which properly projects forward everything. You can see very visually what your situation looks like. And they want me to run two scenarios basically. One, they stay in the UK, and how would we run the investments, the assets that way? And the second one, if they return to Australia. So, at that point they'd be transferring pensions from the UK, things like that. Maybe even using offshore bonds. There's various different things that we can do, so they can work out which one of them is going to make financial sense. Once they've got an idea of which one's going to make financial sense, obviously they then need to make the decision of where they actually want to live. But they're kind of on the fence at the moment as far as where they want to live, and if one of them is going to clearly be of financial advantage to them, then they will potentially go to that country. Either go back to Australia or stay in the UK. So they just want to know exactly how that's set up. Now, that couple already have Australian assets from when they originally lived over there. So, even with the UK planning, we need to take into account what they do with the Australian assets. They've got a couple of supers over there, for example, that I'll be doing the UK financial planning for. But the guys over in Australia will have a look at those supers and work out whether they're invested in the right way, etc. So yeah, we can certainly deal with those two sides, making sure that you've got the money in the right places, depending on what you end up choosing. And if you are uncertain about the future, well, that's fine. We can't do a financial plan now that in 5-10 years is going to look exactly the way that we plan it now. Things don't work out that way. Investments don't do exactly what you want to do. Taxes change, circumstances change. It's and the objectives change as well. So it's a plan that we can start working with now, and then we adapt it. So if you were originally saying, well, I am going to stay in Australia, and then and if something happens and you start to plan the move back to the UK, well, that's fine, because we can then start to look at how you change the assets for the move back. As long as we're doing these things in plenty of time, then we can certainly find the tax efficiencies in there for you. Okay, Paul's question is, we've decided to return to the UK. We're retired and over 60. When do I have to become a UK tax resident post arrival in UK, considering Australia and UK have a dual tax agreement? Well, that all comes down to, once you've arrived in the UK, it all comes down to where you spend the majority of the year, basically, as to whether you become a tax resident. So, once you've spent more than 6 months in the UK, it'd be hard to argue that you're not a UK tax resident, essentially. So yeah, that's basically, I think the best way to approach it when you're moving back is just to assume right from the outset that you're going to be classed as a UK tax resident, and plan around that. Yeah, there can be some split year treatment, and we can get involved in that and trying to take advantage of it, because you can take advantage of years where you're split between the two. But essentially, you're not going to get away with that for long. Basically, you will be a UK tax resident if you're going to be spending the majority of the year here. Okay, Sean's question. Transferring from a QROPS to a non-QROPS, who monitors that? How is it allowed in the first place? It seems silly to do that and then incur a penalty. Yeah, it is. You're right. Is this possible in self-managed funds and without the advice of an advisor? John, do you want to take that one?
Yeah. In most cases, the administration of the self-managed super funds we look after from a compliance point of view. However, for those who want to administer their own super fund and invest, they make a declaration to the HMRC that they are the responsible manager of the actual fund themselves. So if they decide it's all too hard and want to roll it over to a normal super that's non-QROPS and don't report it, it's where the penalties are line. So they have to be, as I said, they've got, I think it's a 10-year reporting, Paul, is that right?
Yes.
Yep. and then once that's completed, by all means they can roll over to a non-cure ops because they've finished that requirement by the HMRC.
Yeah, I mean the reporting period can be longer than the period in which you're subject to the cure ops rules, and therefore technically within that period, if you were to transfer, as long as you've satisfied the member conditions of the cure ops rules, you're outside that, then you could transfer to a non-cure ops even when it's still within the reporting period. But and the whole point of that is that HMRC originally didn't have a reporting period that was longer than the member provisions period, and that meant that they had no idea really what was happening once that member provision period finished. So they just wanted to get an idea, I guess, of what was happening with the funds afterwards, how many people were doing different things with them afterwards. So yeah, the cures rules are still fairly new. They only came about in 2006. So we've seen a few changes along the way to how they work. For example, in Australia, you can only transfer a pension to Australia once you reach age 55, in line with the minimum pension age in the UK. So that will no doubt go up to 57 in a couple of years' time. So, that's one change that was made after the cures rules came about. There's various reasons, I won't go into it too much, but we've seen that in other countries as well. So, these things do change over time, and that 10-year reporting period is new, but it doesn't necessarily mean you have to wait 10 years. It could be 5 years. In fact, that leads into the next question from Andrew Perkins. Is the 5-year condition unique to each payment, or is it based on when the final payment takes place, as it is looking like it will be 10 years plus to transfer my pension to Australia? It's basically when you make a transfer, you're then subject to those cures rules. So yeah, I mean, it's likely to be quite a long time until you're outside of that provision, because you're making a transfer over there. Each transfer is going to be subject to those rules, basically. But having said that, as far as how long you've been outside the UK is concerned, that's one of the conditions. So you will have obviously been outside the UK for a long time at that point. So it may not be as restrictive as you might think. But to be quite honest, whether it's in a fund that's got cure ops status or not, it may well be that you stay in that fund long term anyway, because it might just be the best place for you to be. So if, for example, you're in a self-managed super fund in Australia that has cure ops status, well, it's a self-managed super fund. It's the same as any other self-managed super fund, and it, you'll have investments within there. It just so happens that you've gone and applied to HMRC for a cure ops certificate. It doesn't mean that it's a separate policy that is more expensive than other self-managed super funds, etc. It's a lot of people misunderstand this about cure ops, that cure ops is not a product. It's a scheme, a registered scheme in another country that has permission from the UK government to accept a transfer of funds from a UK pension, and it will agree to adhere to those reporting requirements, and ensuring that the rules aren't broken within that time. So that's all it is. So that scheme has a little bit of extra responsibility each year to do the necessary checks and the necessary reporting when events take place. But it should be, you may well find that whether you're outside of that period or not makes no difference to you, because you've just got a super fund that's continuing to run. I think hopefully that answers your question. Question from Paul saying, how can I retain Australian dollars while living in UK with some growth until the exchange rate is favourable? So if you're leaving Australia and coming back to the UK and you're keeping some investments in Australian dollars, John, perhaps you can say what would happen there.
Yeah, so it's a bit two ways. So we invest in Australia. If you're retaining funds here, obviously it's invested in Australian dollars. It's a little bit different in the UK, where, especially for our company, we've got pension funds that we look after, where we can invest either in GBP or Australian dollars, and we have separate portfolios depending on the currency that it's going to be invested in. As far as investing in British pounds in Australia, so depending on the superannuation that you have, so if it's a self-managed, potentially you could invest in British pounds from your Australian super fund. We, especially our advisors can actually set up UK investment portfolios within the self-managed super fund. So yes, the answer is yes. We can retain it in either currency until you're ready, or there is a more favorable exchange rate. Yeah, but if it's retaining it in GBP until the exchange rate is favorable for Australia, that's fine. If you get a really favorable exchange rate to convert to Australian dollars, it's interesting, and you might not be 55, you might not be able to transfer it, but you can. The bonus that we have in our company is that you can convert from GBP to Australian dollars and still be in an approved model portfolio, investing in Australian dollars prior to coming to Australia. So it can decrease the risk of currency from a strategy or planning.
Excellent. So we've got one final question. So if you have got any others, get them in quick in the Q&A. We've got one from Ria, who says, if you have property in limited company in UK and move back to Australia, what are my obligations? Would it be best to have in personal name instead? Well, Ria, that's quite a specific one. It's not something that's easy to answer. So what I would say is it's probably worth having a chat, directly with you, to see exactly what your overall circumstances are and where it all fits in. And it could be something that we might be able to help on the financial planning side of things, but it could also be that you might need to get our sister company, BDH Tax, involved, who are duly qualified accountants in the UK and Australia, to ensure that that you do the right thing as far as that's concerned. So there is a kind of grey area, if you like, between financial advice and accounting. We each know a bit about each other's jobs, but sometimes it just goes a bit too far over into the other one. And with property and companies, closing down companies, property portfolios, things like that, very often it can just be purely a tax question, if you like, rather than necessarily a planning one, and needs a little bit more bespoke tax work. So that's why we have the sister company, BDH Tax, who can either just do that piece for you or work in conjunction with the financial planning side of things, which is probably the better way to do it, to have both of us working for you in conjunction with each other. So yeah, that sorry, I couldn't be more specific there, but it's one of those questions that's not easy to answer without knowing more about you. Okay, another question from Paul. Safest method, destination for funds transfer from Oz to UK, with or without exchange? It depends on what funds you're talking about, Paul. In terms of pensions or investments, cash, it's a difficult one to answer without knowing exactly what your question is. So if you it's cash, good. Okay, thanks, Paul. Okay, as far as moving money between the two countries and two currencies is concerned, I would always highly recommend the services of a currency broker. In fact, it's an easy way for me when I first start working with people, if they haven't used a currency broker before or weren't planning to, and we're just going to send money from bank to bank. Well, that's a quick win for me in terms of financial advice and putting people in a better financial position, because I can put them in the direction of a currency broker. So currency brokers tend to give you a much better exchange rate than banks do. Because it's the main core part of their business, whereas banks obviously have branches everywhere, they're doing other things, and the currency exchange is a minor part of their business. So because currency brokers tend to work out of one office, their overheads are lower. They also, they're dealing with much larger amounts each day, so they tend to be able to offer you a much tighter spread. And what I mean by that is there is an interbank rate that all of these various companies buy their currency at, and then they sell it to you at a lower rate. And that difference, that spread, with banks can quite often be 3, 4, 5%, the spread that they offer, whereas currency brokers very often 1% or less. So with a currency broker, for example, that we work with on a regular basis within pension funds, and with people's cash as well, as long as we're trading a certain amount, then we get a spread of 0.3% on that. So you can negotiate with them and get a really good deal on that. But it's not even so much just about that. It's also about speaking with them about the services that they offer on the periphery of that. So things like forward contracts and market orders, where you can set the rate that you want to try to achieve, and if it hits that rate, it will automatically trigger. They will automatically buy the currency for you and then ask you for the cash. So it gives you a chance to, if you're not in a massive rush, to sit there and wait to see whether the rate that you really want, eke out an extra few cents in your pound, for example, and you will get, particularly if you're dealing in hundreds of thousands of pounds, or hundreds of thousands of dollars coming back into pounds, those little differences can make, the little difference in the exchange rate can make a big difference to what you get in terms of your currency exchange. So that's basically, when you say safest method destination, I think bank to bank is fine, but so Paul, you've said, for me it is also about safety, is that there are many scams about. We need reputable company when transferring my life savings. Well, yeah, totally agree with you. You need to go with a reputable company. Speak with us about your situation in general, and we can give you some guidance as to what you should do, and also put you in contact with some good currency brokers. So ones that we trust. Let's put it this way: there's one currency broker that we use where my parents-in-law moved to Spain a few years ago, and they had ongoing pension income coming to them from the UK, so they were always going to have to change money into euros. And so I spoke to them and said, well, are you using a currency broker? And they said, no, we were just going to transfer bank to bank, like a lot of people do, because they're not aware of what currency brokers do. I put them in contact with the currency broker, and they found them to be really helpful, and they're getting a better deal on the exchange rate. Now, when you're talking about safety and making the right recommendation as well, you can't get more risky than advising your parents-in-law. So I think from that point of view, it's we certainly make sure that we deal with companies that we feel are reputable. So yeah, I was kind of putting my neck on the line with that one, but thankfully it's worked out really well for them. Okay, so any other question? Oh, we got another question as well. Okay, does your firm have a view on what would happen to GBP AUD effects? The golden question: what's going to happen with the exchange rate? Gosh, if I'd had a crystal ball over the last 12 years, I could have made a lot of money. It's a funny one. I've spoken with currency brokers over the last couple of years, and even they are reticent to give an opinion on that one. The world has been obviously a very weird place in the last couple of years. It's a really difficult one to look at. All I can say is over the last year or so, the exchange rate, it has got slightly better in terms of sterling to Australian dollar, but of course that means in the other direction it's not so good. It has got, sterling has strengthened against the dollar in the last year, but not by much. And it hasn't been moving by big amounts in general over the last couple of years. We've gone through quite large periods where it's been fairly static. And I think that's just because there's so much uncertainty around at the moment. And, you always get small movements, and that will always be a case of news coming out of the UK, news coming out of Australia that change these things. The exchange rate I've found over the time that I've been dealing with it is a bit like investments. It can be very sentiment driven. So what you'll find is that, if a bad piece of news comes out, you'll find that there's a big change in the exchange rate, just like would happen with investments. But then it tends to bounce back a bit afterwards because people realise, oh, that wasn't quite as bad as we thought. So people do overreact a little bit, and it can change the exchange rate. But over the last couple of years, I think there's just been so much uncertainty that it hasn't really done that. So we have been in a relatively tight range over recent times. Whether that will continue in 2022, well, who knows? 2 years ago, or just under 2 years ago, when COVID first hit, did we think that we'd still be working? Being advised to be working from home in January 2022 and have the sort of numbers that we've still got of it. I don't think anybody would have thought it was going to last that long at that point. So, who knows what 2022 is going to bring about. It's a really difficult time to offer any sort of opinion on that. Feel free to speak with the currency broker and see what they say about it, but I dare say you'll probably get a very similar answer from them. Okay, so it doesn't look like we've got any other questions, unless anybody wants to get one in quickly. Otherwise, I think it doesn't look like we've got any more coming in. So that just remains for us to say, thank you very much for your time today. We hope you found it very useful. If you do want to get in contact with us, it's inquiries@bdhsterling.com. So again, that's inquiries@bdhsterling.com. So send us a message there, and then we can point you in the direction of either an Australian advisor or a UK advisor, depending on what your questions are, or maybe it might end up being a combination between the two. So yeah, you will get after this webinar, you will get a recording of it as well. So if you want to go back and have a look at it, and again, you can obviously send that link on to anybody else that might be interested as well. Yeah, so I hope you found that useful. And as we've not got anything else coming through, we shall say goodbye. Thank you again.